In the grand and often tragic theater of the stock market, there is a pain more acute than a simple loss. It is the ghost of a great victory that was held in the hand only to vanish into thin air. It is the experience familiar to nearly every speculator of watching a magnificent paper profit, the fruit of a correct and timely decision, wither and die on the vine, ultimately turning into a loss. This failure, not of analysis but of discipline, is one of the most common and soul-crushing experiences in Wall Street. The speculator asks himself, his account diminished and his confidence shattered, how did I let a winner become a loser? The answer lies in the absence of a single crucial tool, a mechanical, unemotional, and ruthlessly efficient rule for protecting what is already yours. Jesse Livermore understood this problem with the clarity of a man who had paid for his education with millions of dollars. He knew that letting a profit run was only half of the equation. The other, equally critical half was ensuring that those profits, once earned, were not given back to the market in a moment of indecision or a fit of hope. He searched not only his own vast experience, but also the methods of other successful operators for a solution. He sought a trick, a method so simple and so powerful that it could mechanically protect a speculator from his own worst enemy, the emotional desire to hold on too long. He found the perfect embodiment of this principle in the story of a professional gambler named Pat Hearn. This was not a complex algorithm or a secret formula, but a piece of profound, practical wisdom that, once understood, has the power to transform a speculator's entire career. It is the ultimate mechanical trick for protecting 100% of your hard-won profits from the market's inevitable and often violent reactions. It is a rule that replaces fear, hope, and guesswork with the cold, infallible logic of simple arithmetic. It is the one-point stop-loss rule, a masterclass in the art of making profits permanent. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed, chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The story of Pat Hearn, as recounted in Reminiscences, is the story of a man who approached the market not as a hopeful amateur, but as a cold, calculating professional gambler. He was not looking for long shots or trying to predict the top of a move. He was looking for sure money, for a system that would allow him to extract a consistent living from the market's fluctuations. His method was a perfect marriage of aggressive pyramiding and ruthlessly defensive money management. His offensive strategy was simple. He would buy 100 shares of an active stock. If and only if that stock went up by 1% would he buy another 100 shares. On another point's advance, another 100. He would continue this process, adding to his line on a rising scale, always and only reinforcing a position that the market had already proven to be correct. He was building a pyramid on a foundation of success, his largest commitments made only when he was already substantially in profit. But it was his defensive strategy that contained the true genius, the mechanical trick that made his method so powerful. With every new purchase, with every new layer he added to his pyramid, he would immediately place a stop-loss order exactly 1 point below the price of that last purchase. This was not a mental stop. It was a hard, physical order on his broker's book. It was an unbreakable, non-negotiable rule. Consider the simple, beautiful mechanics of this. Imagine he buys his first 100 shares at $50, his second at $51, his third at $52, his fourth at $53. He now has a substantial position, but his stop-loss is not placed below his original entry at $50. It is placed at $52, exactly 1 point below his last purchase price of $53. As the stock continued to rise, he would simply move his stop up with it, always keeping it anchored just 1 point below his most recent addition to the line. The result of this system is a fortress of protection around the speculator's profits. The risk is surgically and precisely contained. At any given moment, the only capital truly at risk is the small 1-point margin on his very last purchase. All the profits from the earlier lower-priced purchases are locked in, shielded by the trailing stop. A sudden, sharp reaction in the market, the kind that so often wipes out the gains of the undisciplined trader, could not touch him. A 1% reaction would trigger his stop and he would be taken out of his position. But the beauty of the system is that he would be taken out with the vast majority of his profits intact. The small 1-point loss on his final lot was an insignificant price to pay for the preservation of the much larger gains he had accumulated from the very beginning of the move. He had found a way to let his profits run, while making it mathematically impossible for them to run away. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, from the deep value principles of Peter Lynch, to the pioneering trend analysis of Charles Dow and the modern psychological insights of Ed Seykota, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. The true power of the 1-point stop-loss rule, however, is not just mathematical but psychological. It is a system designed to completely remove the speculator's greatest enemy, his own emotional indecision, from the most critical part of the trade, the exit. For the average trader, the decision to sell a winning position is an agonizing one. His mind is a battlefield of greed and fear. Greed whispers to him to hold on for just a little more, that the top is still far away. Fear screams at him to sell now, that the profit is about to vanish. He is paralyzed, caught between these two powerful, conflicting emotions. Pat Hearn's rule eliminates this internal conflict entirely. The decision to sell is no longer a matter of opinion, feeling, or guesswork. It is a mechanical certainty. The rule is the rule. If the stock reacts by 1 point from its high, the position is closed. There is no debate, no hesitation, no room for the corrosive influence of hope or fear. The action is automatic. This frees the speculator's mind to focus on what truly matters, identifying the next great opportunity, not agonizing over the management of a current one. It is a form of pre-commitment, a contract made with oneself in a moment of calm, rational analysis, to be executed automatically in the heat of the market battle. It is the ultimate expression of trading discipline. It is the acknowledgement that in the midst of a volatile market, the human mind cannot be trusted to make a rational decision about profit-taking. The 1-point stop-loss rule is a way of outsourcing that decision to the cold, hard, and infinitely more reliable logic of simple mathematics. Livermore so admired this principle that Lefebvre used it to illustrate a crucial point. He tells the story of another trader, a man named Roberts, who had learned Hearn's system and used it to make a fortune of over $100,000 in Lackawanna. He had followed the rules, pyramiding his winners and protecting his profits with the mechanical 1-point stop. But success, as it so often does, bred a fatal overconfidence. Having made his stake, Roberts abandoned the very system that had made him successful. He entered a new trade, and when a reaction came, instead of letting his 1-point stop take him out, he let them run as though they were profits. He had fallen victim to hope, the speculator's deadliest poison. He had abandoned the mechanical certainty of his rule for the emotional gamble of a guess. The result was inevitable and swift. Of course, every cent went, the story concludes. He was not just broke, he was in debt to his brokers. This cautionary tale is the flip side of Pat Hearn's success. It is a stark, chilling reminder that a rule is only as powerful as the discipline to follow it. The 1-point stop-loss system is not a magic charm, it is a tool. And like any tool, it is useless in the hands of a man who refuses to use it. Roberts's failure was not a failure of the system, it was a failure of the man. He had allowed his emotions to override his own proven, profitable methodology. He had abandoned the cold, hard shield of his rule for the warm, comforting, and ultimately fatal embrace of hope. The tragic story of the trader who abandoned Pat Hearn's system is not an isolated one. It is the story of nearly every speculator who has ever tasted success, only to see it crumble into dust. His failure was not a failure of analysis or a lack of intelligence. It was a failure of character, a surrender of discipline to the corrosive influence of hope and ego. He had been given a perfect mechanical shield, and in a moment of overconfidence he cast it aside, choosing to face the market's onslaught unprotected. His ruin was not an accident, it was an inevitability. This brings us to the very heart of the matter, to the profound psychological truth that underpins the 1-point stop-loss rule. The average speculator hates to take a small loss. It feels like a defeat, a small, nagging admission of failure. His ego, which craves to be right at all times, rebels against it. He would rather risk a large, catastrophic loss in the hope of a miraculous recovery than accept a small, certain loss that confirms his immediate error. This is the great, fatal flaw in the psychology of the amateur. Jesse Livermore understood this flaw perfectly because he had seen it so many times, both in others and, in his weaker moments, in himself. He knew that the key to lasting success was to transform this perspective entirely. The professional speculator does not view a small loss as a defeat. He views it as a necessary and routine business expense. It is the cost of gathering information. It is the tuition fee for a market lesson. It is the price he pays to confirm that he is on the wrong side of the market at that particular time. He saw speculation not as a series of individual heroic battles to be won or lost, but as a long-term business enterprise. A successful businessman does not expect every single venture to be profitable. He expects to have costs, expenses, and occasional setbacks. His success is determined not by the absence of these costs, but by his ability to ensure that his profitable ventures are significantly larger than his expenses. The 1-point stop-loss rule is the ultimate tool for managing these speculative expenses. It transforms the entire emotional landscape of trading. The speculator who uses it is no longer a gambler, his fate hanging on every tick of the tape. He is a business manager, a professional risk assessor. He knows before he ever enters a trade the absolute maximum amount he can possibly lose on his latest commitment. That knowledge is a source of immense psychological power. It frees him from the paralyzing fear of the unknown, from the nagging anxiety of an undefined risk. Consider the mental state of the trader without such a rule. He is in a perpetual state of uncertainty. His profitable position is a source of constant, low-grade fear. His losing position is a source of desperate, consuming hope. His mind is never clear, never at peace. He cannot make rational, dispassionate decisions because his every thought is colored by the emotional weight of his open trades. The trader who employs a mechanical stop, however, is liberated. He has outsourced the decision to an unemotional, mathematical certainty. He does not have to ask himself, should I sell now? What if it comes back? What if it goes lower? The rule has already answered those questions for him. His job is not to agonize, but to execute, to follow the plan he laid out in a moment of calm, rational clarity. This is the freedom of discipline. Livermore himself, for all his genius in reading the tape, knew the value of such mechanical certainty. He wrote in his own book, "The speculator has to be his own insurance broker, and the only way he can continue in business is to guard his capital account." The one-point stop-loss rule is the ultimate insurance policy. It is a premium paid in the form of a small accepted loss to protect against the catastrophic uninsured event of a major market reversal. It is the practical application of his most foundational principle, capital preservation. He knew that a speculator's capital was his lifeblood, his inventory, his means of staying in the game. To protect it was his first and most sacred duty. The one-point stop, applied to every new commitment in a pyramided line, is a perpetual inventory management system. It ensures that any bad product, any part of a trade that turns against you, is immediately removed from the shelves before it can spoil the rest of the goods. For the modern trader, the lesson is not necessarily to adopt the literal 1 point as an absolute figure. The markets are different, the volatility is different, and the nature of the stocks is different. The lesson is in the principle. The principle is to have a clear, mechanical, and absolutely non-negotiable rule for exiting any commitment that proves you wrong. It may be a percentage of your account. It may be a specific dollar amount. It may be a break of a key moving average or a violation of a Livermore-style pivotal point. The exact nature of the rule is less important than the fact that it exists and that it is followed with unwavering religious discipline. It must be a rule that is defined before the trade is ever entered, in a moment of calm, objective analysis. To create the rule in the heat of the moment, when you are already in a position, is to invite your own emotional biases to corrupt the process. This is the great dividing line between the professional and the amateur. The amateur operates on impulse, on hope, on fear. He makes his decisions on the fly, his strategy shifting with every tick of the tape. The professional operates according to a plan. He knows what he will do when the market goes up. He knows what he will do when the market goes down. And he knows what he will do if the market goes nowhere. He has a rule for every contingency, and he follows that rule without question. To adopt a mechanical stop-loss system like Pat Hearn's is to take the first and most important step across this dividing line. It is to declare that you will no longer be a slave to your own destructive emotions. It is to commit to the path of discipline, of professionalism, of treating speculation as the serious business that it is. It is to understand that long-term success is not about making brilliant guesses, but about surviving your own inevitable mistakes. This, then, is the ultimate trick that protects not just your profits, but your entire speculative career. It is the shield of the professional, the simple, powerful tool that allows a man to engage in one of the world's most perilous games with a quiet and profound confidence. He is confident not because he believes he will always be right, but because he knows that he has a system that will protect him, without fail, on all the occasions when he is wrong. And in the business of speculation, that knowledge is the only true source of lasting power.